As investors digest the soft GDP data and prepare for another round of earnings, we want to welcome in Keith Lerner, the Truist Co-Chief Investment Officer and Chief Market Strategist. Keith, thank you as always for joining us here today. I'm wondering what you make of this latest data release and also the trip that we've seen in earnings, especially Meta down so much. This comes after we've gotten better than expected data on the labor market and inflation. So what should investors be focused on here?
Yeah, well, first, great to be back in studio with both of you. I mean, you described it well, Jared. We have a bit of a split market today. I will say, overall, we're actually becoming more positive as we've pulled back, and we're getting kind of this excess sentiment euphoria that we saw after 5 straight months of gains, that really strong first quarter. And even today, the GDP report itself, if you look underneath the hood, it was fine. It wasn't great, but it was fine. Consumers still spending, businesses are still spending. You saw some of the more volatile areas of that report, like inventories and trade, kind of bring it back. The underlying demand is fine. I think the market's hanging in there relatively well despite the yields moving higher. 4 or 5 sectors are up today. So what we've been saying to folks is we actually think the risk reward is somewhat improving as we pull back, as we work off some of that excess sentiment. And the other thing is, going back to interest rates, we did have a little bit of a hotter inflation number, but the market had already repriced the Fed so dramatically from early in the year. It's not having that same impact that it would have before.
And yet, it repriced the Fed so dramatically because it seemed like economic growth was strong, and that's what was pushing up inflation. Do we run the risk of a stagflation scenario here where things are not growing as much as people thought, but inflation is still not coming down?
Yeah, it's a risk. It's not our base case. And listen, this is one number. And again, if you look at the components of the GDP, it was still solid economic growth. And don't forget, underneath that today, we also had initial jobless claims at 207,000. So what does that mean? That means people are still working and wages are still going up, and therefore that should still power the economy forward. We've been expecting a step down from that really robust growth of the last 2 years after the pandemic, but we still think we're probably closer to 2%. And nominal GDP growth today is about 4.8%. And if you think about the stock market, that 4.8% should be good for sales, and that should be good for earnings. And one of the reasons why we maintain more of a positive outlook, especially as we're pulling back here, is that forward earning estimates for the market every week are making new highs. And we just saw that again. We think that's going to continue and provide a balance as far as, with this decline. I think from where we are today on our work, looking at the historical norms, we think, 2 to 5% is probably limits the downside from where we are today.
Yeah, I've seen a bunch of strategists saying there's a short-term opportunity, at least for maybe a couple-week bounce here, just given the setup. But I want to focus on sector action. Yep. You recently upgraded the energy sector. Yep. I have on the Wi-Fi Interactive year-to-date sectors for the large cap stocks. This is the S&P 500. Energy is up 15%. That is the number one sector. Guess what number 2 is? Financials and then industrials. Then we get one of the mega cap sectors. So things have changed here a little bit. Yeah. Just wondering what's behind your energy call and what other sectors you might like.
Yeah, well, also going back to the economy, the market tends to be a leading indicator. What you just said, energy, financials, industrials, those are the most leveraged sector to the overall economy.
Yes.
So the market is telling you that we don't have a growth problem at this point. So we've been overweight financials most of this year. We upgraded industrials a few weeks ago. And then energy had a big move up. It pulled back, and then we upgraded it. Part of our sector strategy is based on price momentum, so positive price momentum and relative price momentum. Jared, I know something you look at quite a bit. The other side of it is valuations are still relatively cheap for the sector. And as energy prices have rebounded, we're seeing the earnings momentum also move forward as well. And I think it's also a good hedge for geopolitical risk as well. So I think it has different facets in this, as you said, kind of confusing market backdrop that we've been in here more recently.
So you are newly more positive on energy, but you have been positive on technology.
Yep.
And comm services, and it sounds like you're staying that way.
We are. We were positive on those areas for some time. With tech, it's typically 2 steps forward, 1 step back. And right now, obviously, like communication services, that sector is so dominated by Meta and Alphabet. So we'll have to see what happens after the bell today as well. But I think big picture on tech, it's hard to be negative on tech longer term, because even if the economy does slow down, businesses will likely have to continue to spend on tech, otherwise be left behind. The other thing, more fundamentally, what we look at on tech when it outperforms is when the earnings momentum is stronger than the overall market. And so far, those trends are still intact. I will say we're starting to see more of that bifurcation. Like today, so Meta's down a lot, but the semiconductors, as you alluded to earlier, are up because Meta is going to be spending more money on CapEx, and that means semiconductor demand is going to stay high. So I think you're going to see more of that kind of two-way, more granular type of market likely continue.
I want to stick with that for a second so I can show this on the Wi-Fi Interactive. If I could get that up here. We have the semiconductor heat map today. You see NVIDIA here up 4%, Taiwan Semi up 3%. We're looking for those Intel earnings after the bell. And then we switch over to software. That is night and day. So maybe this is an idiosyncratic story. Maybe this is they're outweighed by some of the IBM earnings, and maybe we can talk about this all day. But I'm just wondering, going forward, do you think? And you've talked about the overall market correction. What should investors who still like the Mag 7 trade really think, and who likes the growth trade? What should those investors think right now?
Yeah, well, I think often people think you have to be all in on one area of the market, or all out, and I don't think that's the way you should be. And even this day, the Mag 7's like people are calling it the Fab 4, and I don't know after today, maybe it's the Fab 3. I don't know. So the way we're thinking about it, we're still overweight tech longer term. We still think the earnings momentum, and we think the secular story is there. But to the point about energy and financials, those are things that will be positive for like the equal weight S&P. So what we're doing, even with the portfolios that we manage, we still have core positions in some like the S&P that is tech heavy, but we're diversifying that concentration risk, which we're seeing the last couple of days, with something like the equal weighted S&P, which again is basically every stock in that index is weighted the same, so you don't have that concentration risk. And if the economy still stays somewhat resilient, which we think it will, those areas should do somewhat better. So I think, and that's also going to the mix of these sectors that we talked about. You got growth and the more cyclical areas where we're still more negative as some of the defensive areas of the market that have been underperforming, having a little bit better day today, but we think that there's not a lot of value there at this point.
And just to go back quickly to tech and the sort of growth cycle and where we are in that growth cycle. So if the likes of a Meta, and we will find out more after the bell from the others, are spending, that's benefiting the semiconductors. When is it going to benefit the ones that are spending? When is it going to benefit them? I mean, we saw in the last spending cycle for Meta, it was spending all that money in the metaverse, and the market said, no thank you. And that maybe that's bearing a little bit of fruit, what it's spent on the metaverse, but
I mean, you're right. It's like
it's
when
you try to get your arms around the opportunity.
When is the revenue opportunity going to come in? I mean, the reality is they control the data, and I mean, the next phase is going to be the more product releases, and then also the companies after that. Who's going to amplify this data as well? But the reality with AI, it costs so much money so they're spending all the money on semiconductors because they have the money, so they're going to have an advantage of exactly how that all translates and when is a difficult question. But I think longer term, I wouldn't bet against these big companies because they have the cash flow and the balance sheets to really stay in this longer term than some other companies that just won't be able to spend the money to be competitive in this field.
Keith, thanks for coming in. Great to see you.
Always good to be with you guys.
Appreciate it.